So guys, today we're going to discuss a binding private ruling in relation to section 24J. It is an issue regarding the deductibility of interest. For those of you who don't know, I'm Nico, Managing Director of Unicus Tax. Please bear in mind that these training sessions are intended for my staff and for those of you joining online for your interest only. Right, so binding private ruling 424. This is a quick ruling that we're going to discuss very quickly. We'll be quick on it. But I want to repeat what we said last week, because last week we discussed a VAT ruling, right? And I asked the question, why, if these rulings are not binding in relation to anybody other than the applicants in this ruling and in last week's VAT ruling, why do we look at them if they're not binding? Well, we look at them because they give us insight into how SARS views a particular thing. It refreshes our memory on many things, and unfortunately with rulings, because they are so over-sanitized, you don't often, if you don't consider it deeply and thoroughly, you often don't get the point of the ruling. You read it and you go, and so what? What's the point? So what you need to do is, when you are considering a ruling, if you really want to get a value or learn from a ruling, you need to sit down with the thing and ask the questions, because the ruling itself is not going to answer, it's going to answer the question that was posed in the ruling, but it's not going to answer the question, and this is the critical point, is why did these people go for a ruling in the first place? What uncertainty was there that necessitated them getting confirmation from SARS? Because often I get people that read these rulings and they go, yeah, they're obvious. Yeah, it's not that obvious. If it was that obvious, they wouldn't have gotten a ruling on it. And why do we get rulings? Because it creates certainty. And I've said this before, I said it in last week's session, and I don't think any one of you was involved in the ruling. Maybe you, Mika, was involved in a recent ruling application that we did. Nobody, yeah, okay, so the guys that attended that or did that ruling. So it's often where you have several stakeholders, right, involved in, for example, something that could, so for example, a VAT issue, right, we have a business that's built, so the client yesterday, I spoke to the day before yesterday, what's today, Tuesday, no, yesterday, spoke to someone yesterday, I said the whole business is modeled around their ability to claim input tax, comes along SARS and says, but you're an exempt enterprise, right? Okay, I understand where SARS is coming from. I'm not saying I agree with them, but you can see the criticalness of this issue. This is not something where an opinion, well, it will work, but you're going to fight the fight every time, every VAT return goes in, somebody's going to ask a question. What you want to be in is in a position where you can go to that auditor and say, here's a ruling from head office, this is clearly an enterprise. Because it's not that, and that as you thought. It looks like it. I appreciate that it looks like that, but it's not that. All right, so this ruling really governs the issue of whether interest is deductible when the loan on which that interest was incurred was used to redeem pref shares and accumulated preference dividends at the point of redemption. Right? So let me just give you some context, and bear in mind, I can only give you context to the extent that the context is in the ruling. So I'm not being vague on purpose, I'm giving you as it stands in the ruling. Right, so these guys, the taxpayer, went to some institution to borrow money, right? And it was going to borrow money to do some form of construction project, and it's going to cover some initial startup costs. The ruling is very vague on what it is, but what we can see is that there's a sum of money that they want to borrow, and we can see that this money is going to be put to productive use. Right, it's going to fund the cost of construction and some startup costs. Now, the way they structure this finance deal is that they say 40% of the money that we need, we're going to get in cash, right? And 60% of the money that we need initially is going to take the form of the lender effectively subscribing for preference shares, right? And we all know that preference shares is really pretty much very, very similar to debt, right? And why the banks would do that, it's got nothing to do with the fact that the interest, the dividend is tax exempt and why there's section 80 and 80A, but that's not what the ruling is about. So there could be various reasons why they would do that. But what is important is when they structure this deal, the taxpayer with this financial institution, they agree in that same financing arrangement that at a certain point in time, we will redeem the preference shares with accumulated interest by getting a cash loan from you and effectively swapping, if you will, that equity, that preference share equity for debt. And the question then arises, right? That loan that they get at a point in time to redeem the prefs and the accumulated pref dividends, what is the tax treatment of that? And this is where you must pause for a second and think, why are we asking this question? Why would they go and ask this question? Let me give you an example. When you do a tax accrual review, right? For those of you who've done tax accrual reviews, you'll know. You look at a balance sheet and you say, okay, here's a loan. There's an interest-bearing loan on the balance sheet, a liability. The question is always, what was that loan used for? Because we know we can only claim the interest on that loan if that loan was put to productive use, right? I'll give you an example, a simple example, something that SARS catches taxpayers frequently on. Let's say I own a flat that I rent out, right? And I had a bond over the flat, and I since got a second bond registered over the flat. But that second bond money I used to go and buy, I use that money to go and buy clothes or to buy a car, right? You will still get a bank statement from the bank saying this is the interest. And people will still continue to deduct that interest against the levy income. That's not right. The loan was used not in the production of rental income, it was used for something entirely different. So you must always ascertain what is it that the loan was used for originally, right? And that determines whether or not, because this is not an issue of 24J and whether 24J applies, it's a question simply of whether it's in the production of income, this debt, because this 60% that they funded initially with prefs, that's later redeemed, because there's lots of case law that says explicitly, if you borrow money to pay a dividend, for example, the interest is not deductible because it's not a production of income. The same with redeeming pref shares or redeeming shares, buying back shares. Interest on that is not deductible. Here, you have a situation where they're going to get money on which they're going to incur interest, they're going to borrow money to settle exactly that, to buy preference shares. And the ruling that SARS ultimately issued is they said the interest on the new loan will be deductible, right? And the reasoning they don't give the reasoning, but the only reason I can think is, and they make a clear point of this in the ruling to say that this further loan to redeem the preference shares, and by the way, it's only deductible to the extent the loan isn't used to redeem preference dividends, accumulated unpaid pref dividends, right? So it makes a point in the ruling to say that you get the distinct impression that the only reason they ruled like this is because the cash funding to settle the redeemable preference shares was agreed to at inception of this loan. It wasn't something that was thought of after the fact to settle the pref dividends. It was structured like this from the beginning, and so there's a direct line of sight between the pref dividends and what it was used for, or the pref shares and what the cash was used for, and what this loan is doing is effectively carrying on with the purpose that the cash served initially, which was productive purposes. It was to do construction and to start initial startup costs. So for those of you joining late, we're pretty much finished, so you can check the whole video on our Unicus Tax YouTube channel. So SARS said this is fine, it's deductible. They did not rule on sections 8E and 8EA, right? And those sections effectively deem certain preference dividends to be income and interest, etc., right? That's because certain institutions, if their money is interest and they can make that, which is normally taxable, right? And if you can earn all your income in the form of exempt dividends, that's morsha nice, right? And so certain institutions would do pref share funding, which is very common, and that generates dividends, which on the recipient's hands is exempt from income tax, unless it is a tainted or what do they call a hybrid equity instrument, a hybrid debt instrument, and 8E and 8EA governs that and says, okay, no, it's not exempt, it's taxable. So SARS says, I'm not ruling in relation to these preference shares, whether or not 8E and 8EA applies. I'm only ruling in relation to the borrower and whether the borrower can claim, or whether the interest in the production of interest and deductible in terms of section 24J. So 8E and 8EA might still apply. All right. So again, the reason for this is, in my view, from what I can see, is it's only because the cash portion that would later substitute or redeem the pref shares was initially agreed to in writing right at the commencement of the loan structure, and you can make a direct line of sight, or there's a direct line of sight or link, if you will, between the pref shares, the pref subscription fees, and the loan, and it was all used for the same productive purposes. Therefore, it's deductible, not to the extent that they repay the preference dividend. Right? So there's lots of case law on this that's not listed in the ruling, but This is the sort of things that the guys who did the ruling would have had to think about and why they went for ruling. You can imagine that these sorts of loans and these sorts of structures typically involve hundreds of millions, if not billions of rands in funding, right? And so if there's case law, as there is, right, which is not in the ruling, by the way, I know this because what we do for a living is tax, right? But if there's case law that suggests that, look, this is a problem, and you've got, call it R1 billion worth of funding, and there's uncertainty as to whether or not we can deduct the interest on this, it will make a massive difference on the overall financial viability of this business model that it is that these guys are getting funding for. And so that's no doubt in my mind, I don't know who these people are who applied for the ruling, but that in my mind, no doubt is the reason why they went for the ruling. If you get nothing else from this ruling other than remembering that in determining the deductibility of the interest, one must go and look at the purpose of the funding, then that's also fine, right? And I have seen oftentimes, especially on companies that got, especially like a property company, so in group structures, you often get, various companies in the group, and often one of them is a property company, which is just the way they structure things, which I also understand because you want to commercially ring fence your risks, so property is ring fenced and operations are ring fenced, etc., etc. Right, and oftentimes the ability, the leverage effectively to borrow sits on the property company because it can offer security. And then you'll find that there's bonds and drawdowns on those properties to fund the group, right? It doesn't necessarily relate to the earning of rental income in that property, but they use the rental to do something else, to pay dividends or to get cash somewhere else. And you have to always trace the loan. Where is the money going to see if the interest is deductible, because the fact that there's a liability on the balance sheet that says interest bearing doesn't mean it's deductible. Right, we must first find the purpose. Of course, transfer pricing is a whole different discussion. But that's it for today, right? I'm going to pause here and give my guys in the office, or the guys around the boardroom at least, and those joining online, to ask a question. Did any of you read this ruling, by the way? Did you have the chance? I know we're extremely busy, so that's unacceptable. No, I'm kidding. So do yourself a favor and read the ruling and see that you will learn very little from the ruling if you just read it and accept it at face value. It's very difficult to get some form of value out of it if you just read it. All right, so are there any questions? Let's go online. Are there questions from the people online? You can either just raise your hand, unmute yourself and ask the question, or you can put it in the chat box. These sessions are supposed to be short because we've got lives and we've got stuff to do and we're busy, right? So I can talk about next week's case law, but then I have an opinion that I need to get out. So does everybody else who's got stuff to do. So questions, yes, there's one hand raised. Please go ahead.
Hi, good day.
Good day.
I just wanted to know if you just give a few reasons as to why people would have the property in one PTY and the normal operations in a separate PTY.
All right, so that is outside the scope of this, but I'll discuss it briefly. So it comes down to commercial risk ring fencing, right? If you've got a business that's got operations and the operations are highly linked to creditors, right? So you've got a business that is exposed to creditor risk. What you will do is you don't want that creditor, or I almost said something else, and I forget I'm online. If there's a mistake or something goes wrong, I wanted to use something that starts with F. If something goes wrong in the operations, you don't want that risk to expose the properties to attachment and those sorts of things. So what they will typically do, or what some people will do, is they will ring fence the properties out into different entities or into a different entity that contains the property, so that the risk is ring fenced, so that one business's operation doesn't jeopardize, or the risk of one business doesn't expose other businesses. In this case, a property business. So that would be a reason why people ring fence that. And you can do that even if you've got existing structures with. Because lots of people tend to do this. They tend to realize this after the business is already worth a lot of money. And they go, oh, goodness, we never thought of this. Now I need to ring fence it. And there are ways that you can do that with using the corporate rollover provisions. Because remember, as soon as you move the property out to another entity, it triggers a tax bill, right? Because even though it's in the same commercial unit, but there are the corporate rollover provisions in, what are the sections? 41 to 40? Come guys, 47. Right? 41 through 47 of the Income Tax Act that allows you to move assets within the same economic unit without triggering, at that point in time, the tax event. It is just a deferral of the tax event. And so we've had one or two cases where we got involved and saying, okay, fine, I understand your business rationale. How do we move this property to a different entity, get your commercial goal, and not trigger a tax event, because really you're not cashing out? And the basic premise of the corporate rollover provisions is that if you're not cashing out, you should be able to transfer assets neutrally as long as it remains in the same economic unit. That's the basic principle. The details of sections 41 to 47 is a different animal altogether. Right, but I hope that answers your question. Are there any further questions? Do you remember the case law on loan deductibility? Do you remember I'm trying to remember the case law. There was, I think it was a doctor's practice where they had to borrow money to buy out one of the doctors in the practice. And the question was whether the loan was deductible. The interest on the loan was deductible. It was more, the question, if I remember, in that case was more to do, which is very similar, I suppose, to the test in 24J, but the judgment I'm recalling is the one on 23G, which is the negative test, which is the expense incurred for the purpose of trade, right? Which is very closely linked to in the production of income, not exactly, but closely linked to it. And so it's the same concept. And when I read this ruling, that's the first thing that came to mind, is that's why they're going for this. Right. There seems to be no further questions either online or in the office. Next week we are discussing, at least my intention is, to discuss a judgment by the SCA, which is not so much from a substantive law really of much value, because the judgment is actually handed down in relation to a decision by two judges of the SCA to turn down leave to appeal, which was then taken on review to the SCA to make a decision whether that decision to grant leave or not to grant leave to appeal is justified. And it comes down to the onus of proof, because the court then sitting saying, is there any prospects of another court reaching a different conclusion? And they go into the detail of onus of proof, which I have said a lot of. I've published probably, I don't know, hundreds of articles on onus of proof. Everybody knows that the burden of proof is on the taxpayer, but it seems very few really appreciate what it takes to discharge that burden of proof. And that's why you keep on getting SARS assessments say burden of proof not discharged, burden of proof not discharged. And sometimes it takes just the smallest nudge or that gap in the evidence to get the case across the line. Because people will say, but I've given SARS, for example, I'll use a silly example, right? I've given SARS a bank statement to show the expense, but all the expense says is it says Chamberlain's 1,000 Rand. What does that mean? How was that expense? How can you show me that expense was incurred to buy a new window frame or whatever, or a hinge for the door, or that you were doing renovations on your second property on? That just shows you that you paid for something at Chamberlain's. What it was used for, I don't know. And that's something that people tend to struggle with. And when they build their defenses, is to put the evidence together to substantiate the case. So next week's session is on burden of proof, and you'll see people still, even in the SCA, try to argue that they discharge the burden. There was some debate in that case about whether or not the evidence of the accountant in the tax court judgment was hearsay and whether it was permissible or not, but it was ultimately hearsay. The guy was attesting to things that wasn't falling into his personal knowledge. And one of the arguments that counsel for the taxpayer wanted to take is that the court admitted the evidence by implication, and therefore the taxpayer discharged the burden of proof, and the SCA said not even by a long shot. That's not, the evidence was never admitted by the court. Right, but we'll talk about that next week. There being no further questions, thank you everybody for joining. Good luck with the rest of your day, and we'll speak to you again. Those of you online, we'll see you again next week. Thanks, bye-bye.